Today's seminar really is dedicated to Stephen Schaffer. It's designed for people in the MBA doing both bank risk analysis in the emerging markets and also bank valuation. Of course, the two are very similar in many ways in that they're both aspects of due diligence. To understand how much a bank is worth, you have to do a risk appraisal of everything about it. And to truly understand a bank risk analysis, at one point or another, you're going to have to come up with how much it is worth. So particularly in the emerging markets, you will find that the two subjects are somewhat interdependent. And why I say Stephen Schaffer of Forbes magazine, because he published an article very recently on 8 reasons about buying a bank in America. And one of the few things that this really did very well was highlight the major differences between buying a bank in the emerging markets and buying a bank in, say, an advanced country like the United States. And the tremendous differences between them. And I thought that that would give a better understanding of how one goes about analysing the value of a bank in the emerging markets. For example, he said that banks, his point number 1 was that banks are sold and they're not bought, i.e. the concept of a hostile takeover of a bank really doesn't work. And culturally in America, I think that's probably true. That wouldn't work, and there would be many problems with trying to get banks to merge together with their different cultures and different ways of approaching things. But in the emerging markets, it was once part of my job, particularly in places like Kazakhstan and in the new opening markets of the CIS, to buy banks to sell. I mean, we would buy banks as an investment. And we weren't alone. Many people like the EBRD, the European Bank for Reconstruction and Development, many people globally in the emerging markets buy banks as an investment. Not necessarily, as in China, for example, to capture a market share in an enormous emerging market, or in India as a classic example, or anywhere that there's more than 200 million people, like Indonesia or Mongolia or countries like that. But we were buying a bank specifically to sell it on later on, or if it didn't fit our portfolio or if it didn't work out too well. What the EBRD do is somewhat similar, and something that you may consider worthwhile when you're looking at doing your own dissertation on value in bank. And that is, they would take a medium-sized bank, a bank that isn't too complex, a bank that had been making a profit for, 5 to 6 or 7 years and slowly turning over money. Not a very fast-paced oligarchic type bank, but a local bank that was just doing reasonably well, no double-digit figure growth, but growth. And they would buy small amounts of equity in it. And that was where the true machinations of real risk analysis in Europe began many years ago, particularly when the markets in Eastern and Central Europe opened up, and still are there today. So it's very different. In America, yeah, it's probably true that chief executive officers get together over a lunch somewhere and decide that their banks are going to merge one way or the other. In the emerging markets, it's very different. We have a big technological gap between buyers and sellers in many cases, and a buyer will actively look for an investment that is going to give them a return on their money. Because one of the things we all understand about the emerging markets is you can make money there. And the money isn't always as risk-free as it would be in a dollar economy, but let's face it, that's the reason why many of us are in this business. He also said, point 2, that local market share matters, not national market share. And of course, in a very big country, that's possibly quite true. For us, it became very true. When we started buying or putting up our own branches or subsidiaries, or buying banks in countries like Russia, to have the name of Raiffeisen Bank, for example, behind the actual local bank's name or with it in some way, interpoled together, then it would add a certain cachet to it. People in emerging markets find a certain amount of comfort in banks from a financial centre like Vienna. And so it would add a certain amount of value. in that we would be actually adding to some of the national market share, and therefore we wouldn't be necessarily looking at it like that. In Russia, it's somewhat different. In Russia, where you have a huge number of banks and a number of different types of banks, local banks and obviously it's very large banks as well. In some cases, you would be adding to a local market share. In some cases, you'd be looking purely at a specific product. And that, of course, is very different. The third point, I think, was the most important, for me anyway, in terms of remembering globally buying and selling banks. He said that earnings determine price, not the book value. Now, I want to repeat that because I think it's a very important statement, that earnings actually dictate the price, not the book value. So what he's saying is that you buy a bank because it will earn you money. And that's probably fair enough. You're not buying cash. You're buying a revenue stream. You're buying a business that hopefully is up and running and is going to make you money. And therefore you would value it along those lines. That wasn't the case before. The case before was that you would have the book value of a bank, which everybody would kind of agree, and which I'm sure you'll get to fairly quickly in your own work for the MBA. But once you received or you got that book value, you would then expect to pay multiples of that book value. So you pay, say, 3 to 5 times book value. There was a kind of fairly narrow kind of market gap in which everybody was buying and selling. Banks, for example, like Banque du Caire in Egypt went for a number of millions of dollars, and they hadn't issued an annual report for about 5 years. But Taiwan wanted in on the biggest Arab-speaking market in the world. So it wasn't unusual for people to sacrifice a certain amount of money and pay what would now seem way over the odds for a bank simply because it gave them access to a market. And in the emerging markets, that's the case today. India, for example, is very difficult to open a banking, as we know, and many, many big banks have issued or opened factoring companies there just to get a foot in the door, and it's been fairly successful by and large. But if you look at some of the other countries like the next 11, Nigeria, Mongolia, Indonesia, countries that you can no longer afford to ignore, that have 200 million plus people in them, whereby, for example, Lagos will be one of the biggest, if not the biggest city in the world in the next few years. Pakistan exports probably the second largest amount of textiles in the world. They can't be ignored. And if you want to get a part of that market share, you're going to have to pay for it. And that's the big difference. We're looking at entering into a market for a specific reason. And when we're looking at going into, for example, Gabon or in other parts of West Africa, we would be looking to spread over a certain area, and you wouldn't be surprised that a bank like EcoBank, for example, with a branch in every West African country, has got that kind of advantage that people would look at and would want to share with them. And that's exactly what some banks have done. Now it's working the other way. So that in the past I was asked to act as a consultant to South African banks, to buy Nigerian banks. Now we're looking at Nigerian banks buying South African banks. And so it goes backwards and forwards all the time. And that's in the nature of emerging markets as they develop. And Nigeria is certainly becoming a bit of a financial powerhouse as far as that's concerned, being the largest economy in Africa, of course. Russia, again, as a large economy, is looking to branch out where it can. And everybody is looking to the emerging markets. But the idea that you would get a bank at book value is really not the case unless you were prepared to take on some awful debts. What you would be getting is, or what you'd be paying, is a certain amount of money or a multiple of that book value for a market share in a market that you want a part of. And that's the only way you'll be able to expand your business into that market successfully. And once you've done that, you'll be able to offer your customers services such as international trade finance and various other risk-related services that your competitors won't be able to. And so to look to expand, well, markets move differently. Myanmar, for example, will be a typical Far East, Southeast Asian market that will grow much quicker and more money will get put into it than a typical African or Latin American economy. That's just the way things go. So if you want a part of Myanmar, and I'm sure many banks are looking at other banks in Myanmar now, you will expect to pay more than the actual book value of a bank. You'll be paying multiples of it. And that's something you've got to take a commercial decision about, whether or not it's worth it. In the long run, we'll all be moving there. Yes, we all laughed a number of years ago when some of the American banks bought very expensive shares in Chinese banks. And we knew that those Chinese banks themselves were not really ready for the tremendous expansion they faced and were sitting on a lot of very bad debt. But it was a sacrifice to go into the biggest market in the world, and that was something that a lot of banks were prepared to pay. Now looking at the corridor of trade between Africa and China, or between the continent of Africa and Southeast Asia and Asia generally, is so vast that everybody wants a part of that. And be able to tie up the business at both ends, well, that's how people like Standard Chartered Bank started 150, 200 years ago. So that earning determination, that determines price, isn't really the case in the emerging markets. You're looking at revenue streams and you're looking at their ability to earn money, of course, but you're also looking at entering into a market which has enormous possibilities for your clients. He also said, this was the fifth point, that the credit problems slow the process down. That's obviously very true. Everything, bank risk analysis and obviously bank valuation, is a due diligence process. So if you want to start looking at bad debts, you will slow the process down. Unfortunately, in the emerging markets, bad debts are an everyday event. I mean, it's not something that we can spend months and months, or waste months and months, going into in such great detail. It's something you're going to have to accept a percentage of, and it's something that you expect. But there are differences here. It will slow the process down. What you're really looking for, and this is a clue to successful both bank risk analysis and valuation, is a very simple tip, and it's based on one very simple concept. If you're looking at a bank's losses, if you're trying to understand a bank on the basis of that kind of risk appraisal, you'll get a very good idea of the mistakes the bank made 5 years ago. Because a bank makes a mistake and it takes a certain amount of time for that bad debt to actually work its way through its books and to show itself up as a poorly performing asset. And that you will find, but you don't want to know that. Well, you may want to historically, but what you really want to know is what the management are thinking now. And so I would go much more towards looking at their provisions rather than looking at their loan losses. I would obviously look at their loan losses. I'd obviously look at a trend analysis of it. But by looking at provisions, I'm getting behind the figures a little bit to try and figure out what the bank's thinking now, what its management policy is. Because what are banks? There's no mystique about banks or banking. Banks are merely collections of executives who make decisions whether or not to put assets on their books, which we would call loans. And those assets either work out or they don't. i.e. they get paid back or they don't get paid back. It's really rather that simple. And I want to get behind the figures I've got to look at the management decision-making process, because that's why banks fail. Banks, as we'll see in a moment, don't fail because of lack of capital, even though that's been the dominant ratio by which banks have been analysed for the past 20 or 30 years. The reality is the capital is not a performance factor. Capital is not put into public banks, for example, that are doing very well. Capital is used to shore up banks that aren't doing particularly well. And to be honest with you, capital never was a performance indicator. It doesn't tell you how well a bank is doing now. At very, very best, it will give you a kind of cushion or a pillar against defaulting assets, but quite an expensive one in many ways. And of course, the banks in the emerging markets, in many cases, particularly in Asia, and particularly in places in the Middle East, are awash with capital. They're cash rich. They have a certain amount of money. They don't have the complex capital markets that we have in many of the financial centres. And there, for them, there aren't the kind of investments or, on the other side, toxic debt to kill them. So therefore, we're looking at something slightly different. So in many ways, I'd be careful about capital and try and understand it from the book as well. Yes, credit problems will affect a bank, but then nobody would have ever gone into China. At the time, the banks were basically completely bankrupt. They had at least 70% non-performing loans on their books. Nobody would have invested in anything like that at all. But banks went in because it was the biggest new market open for them. And that's going to happen time and time again. For many people, Nigeria, Mongolia, Asia, Myanmar, and some of the banks in Russia, for example, and we'll hope that both with Iran and Russia, that sanctions will move slightly soon. These will be prime for in terms of investment, and people will be looking at the banks in the same way the EBRD did. Not looking at the kind of go-go glamorous banks, but looking at steady banks that are turning over money, that maybe have a branch network that is attractive in the major cities. You don't need 2,000 branches. You need branches in places where the traders are. And that's exactly what, in the final analysis, you're going to get. And that was his fifth point. His sixth point was, to my mind, is globally, nobody can really disagree with about, to be honest with you. You're looking for business lines in growth. You don't earn money just by being there. You're looking at their business, and that's absolutely true. You're looking at growth in certain areas. But one of the things he said obviously was more biased towards his own market. For example, that, investment banking is good, other areas of banking aren't so good. Florida is good, Iowa is bad. Now, I can understand, of course, why he said that. But we've got to look at banks in which there are only, or countries, subject, let's face it, to a certain amount of government intervention, or much more so than in Stephen's own country. Not just subject to government intervention, but an intervention that can be irrational, currencies that can be quite risky in some cases. I mean, look what's happening in China at the moment. Countries that are growing like Vietnam quite rapidly at the moment, and some countries that aren't doing so well. In many cases, a lot of Latin America would fall into that particular category. So we're looking at those kind of growth businesses. But what do banks in emerging markets actually do? Well, the vast majority of them do what you'd expect them to do. A fair amount of private banking for high net worth individuals, because there are high net worth individuals everywhere in the world. A lot of trade finance, because that is they're dependent on the sale of their commodities on the global markets and getting a hard currency return for that. A lot of treasury work as well, obviously, because most commodities are denominated in dollars. But a lot of banks in the emerging markets spend a lot of money on FI, on correspondent banking and financial institutions. And what they're doing is they're going around to the banks in the financial centres, trying to get more lines, more loans from them to be able to work more extensively in their own markets. And that's what they do. And that's how they spend a lot of their business and commercial time. So I'm looking for a bank that is not just domestically doing reasonably well, but has put about a certain amount of resources into its international division. And the way to spot that is quite easy. Banks have only kind of two revenue streams coming in. That's their interest-sensitive stream, which is their loans and their loan book, and their non-interest-sensitive stream, or other revenues. And those are the commissions and tariffs that they earn on foreign exchange, on international trade finance, and on various subjects like that. Now, that is cash. That is non-interest sensitive income coming in. That's fees and commissions. And everybody's interested in those. So it's no surprise that I'd be looking for a bank that has a certain amount of flexibility within it, that would put resources, not just in local loans, that will come in and out of fashion, come in and out of profitability with the interest cycle as well, but would also and are also putting money aside for things like international trade, treasury, because that tells me that it's important to them. And if it's important to them, they're going to be an easier partner to work with. And more importantly than even that is the flexibility to move between the two markets. So to look at those two revenue streams and to understand that there are times when it is very viable for a bank to move resources away from its interest-sensitive revenues, i.e. its loans, towards non-interest sensitive fees and commissions, and vice versa, and the other way around. And when interest rates are getting bullish, for them to move back into loans. Now, that kind of flexibility you don't find in many emerging market banks. There will be a certain amount of bureaucracy and officialdom that you kind of expect. I'm sure you would understand why that is. And decisions are made somewhat slower, although some of our own banks can be pretty slow as well, as I'm sure we've all come across in the financial centres as well. But in the emerging markets, yes, there's a certain amount of official requirements, and you would be best looking for a bank that can move between both, that doesn't put all its eggs in one basket, that has a fair loan mix itself, that you can look at and say, well, they don't just do trade finance, they're not just a savings bank or a loans bank, they're doing a little bit of everything. And that's something that I would definitely look for. It's something that Stephen Schaefer really mentions, and I agree with him in that. It's not just faster growth, though. It's also this flexibility, this ability to move between businesses, which is so important. He also said in point 7, the industry is still fragmented. Yeah, that's true. The industry is still fragmented in some countries, in others not so. You will tend to find in many emerging markets a fairly similar pattern, the kind of, if you like, bureaucratic nightmares of the old state-owned banks still there. Maybe banks that you wouldn't really want to necessarily buy, but they're the only name that everybody knows in the international markets, and the only ones that are going to get the kind of credit lines that every bank needs. That is particularly true in CIS and Russia. We all remember the days, for example, of the troubles in Serbia, where there's only Bearbanka, Beogradska Banka, Jugobanka. There were a finite number of state-owned banks, likewise in Poland, until the share prices hit the market and a lot of outside investment came in. There was MBP, PKO, and Bank Handlovi, and that was it. And they were the only 3 banks that had a license to do foreign business. In Russia, Rosveneshtorg Bank, and that was it. And that's a pretty big area to look at. And one bank doing all the main kind of work in international trade. Well, obviously that's changed. And a number of new merchant banks are cropping up all over the emerging markets, particularly in Africa, but also in Southeast Asia as well, and the CIS. I'd be slightly wary of the new merchant banks in terms of the ones that are showing excessive growth. Excessive credit growth has always been, to me, a bit of a red flag. And in Kenya, there have been many problems with banks that have merely grown their loan books simply by taking on higher risk local assets. And I don't necessarily have the expertise to understand that local business as well as they do. But where I see double-digit growth, it's a red flag for me that I know that there may be problems that I want to look at. And this whole process of due diligence is a process of red flags, of trying to figure out what's going on within the bank. The eighth point was purely a monopolist point, that that there is a ban on mergers where banks have over 10% of deposits. Well, there are ways around that. You can always start running off deposits and lower your balance sheet or shrink your balance sheet. And therefore that was fairly easy. That's a fairly easy way of getting around it. But I think what the article showed all in all was that although these 8 points are very, very important, was the difference between bank risk, bank valuation in totally different markets. And that there is a commonality of typologies of banks within the emerging markets that you will find that you will necessarily move banks into a kind of, particularly the retail and commercial banks, into your own categories. You'll be looking at a bank to expand your own network, to serve your clients. And the biggest question of all is, does it make sense? Does it make sense for me to spend my own shareholders' money on a bank in country X, for example, that is turning over a reasonable amount of money, that is certainly a going concern, that has international trade finance, treasury facilities, that has the kind of businesses that I want, but is it really worth the risk? And risks there are, of course, there are not just currency risks. There are many other types of risks. There are government intervention risks. There are all sorts of political risk analysis and sovereign risks. And a bank cannot operate in isolation of those. If you buy a bank in an emerging market, you're buying into that environment. You're buying into that central banking system. But we all knew that. If you're buying into China, you're buying into a bit of the People's Bank of China, which has a currency which certainly isn't completely free and openly tradable. There are ways around it, we know that. But you're buying into the, if you like, fairly erratic entries and exits from the market that the central bank will have. We all know that Asian banks tend to defend their currencies more than banks in other countries. They always did. Particularly in countries like Japan, and of course those of us who remember the far eastern currency crisis in Malaysia, Indonesia and Thailand. But that's completely different. You are now buying a piece of that. And when you go into an African country, you're buying a piece of that political risk environment as well. And you may well be buying into a currency that is much more volatile. You'll be wanting to take local deposits. I mean, that's the easiest way of funding yourselves anyway, and probably the most efficient. You don't want to start buying on an interbank market that's not terribly developed. But you won't have access to local currency unless you do open a subsidiary there or you buy a bank there, and that's the only way you will have access to it. And that's why I was very glad to have worked at Raiffeisen Bank for a number of years, because our policy was that whenever a bank or a country opened for business in Central and Eastern Europe, we would be the first in there. The first into Kosovo, one of the first into Kazakhstan, certainly the first into many of the Central European countries, first into Croatia with the first syndicated loan, I believe, which was for the tourist industry. So we bought banks, we made banks, we developed banks, we did everything that we could with banks in the whole of Central and Eastern Europe. And in Russia, obviously, as well, where we had a number of branches of banks in all the main centres. In some cases, we became almost a central bank. In some cases, like Kosovo, we were the only bank. In some countries, like Albania, we weren't really as forthright as maybe we could have been. But then you've got to look at the bigger macro picture as well. 50% of Albania's exports go to one country, that's Italy next door. And to be perfectly honest with you, Albania is entirely dependent on foreign banks. So some emerging markets will be much more open to your intervention, your purchase of equity in banks, and will be very much lining up for it. They were doing that in many parts of Latin America and the Caribbean, but the money is not there now. In Africa, they certainly is. And there's a lot more intercontinental business going on, I'm glad to say, with some of the larger economies looking to expand into neighbouring Francophone or Anglophone countries, and I'm glad that's going on. But the heart of your analysis has got to be one thing. There will be figures. We expect figures. I mean, you can't do an analysis without a certain amount of figures. But behind those figures is a bank's real thinking, its culture, and its recipe for success or disaster. Banks don't fail because of lack of capital. Banks fail because of decisions made by their managers. And that decision will either be to put a high-risk asset on the book that doesn't work, or not to have a proper liquidity management policy, and not to have access to money in the short term when they actually need it, when there is a slight run on the bank, or the bank isn't doing so well. Those are the kind of decisions we need to understand. That's why banks in Indonesia failed. Didn't fail because of the actual global currency crisis that was going around at the time. They failed because overnight they made 120 odd licenses available to members of the military and gave them banks. That was fairly similar in many ways to the overnight 120, 130 figure of licenses that was given out in Ukraine. But you can't find two more different economies if you tried in the more, or more different countries, if you want to, than you could find. But in terms of investment, Indonesia gained a lot. In the final analysis, only one bank in Indonesia actually survived intact, not being nationalised, not being closed down, and that was Bank Bali. And believe it or not, there were problems with that as well when they did their due diligence, but that came to light a little bit later. Some banks merge because they don't have capital, but they don't fail because of it. They'll do many other things to get around it. And so all I can say to end this particular first video, which will be part of a series that we'll be doing on all the core modules, if you're doing bank risk analysis, please look behind the figures. Please let us understand on the board of course directors that you've understood not just the figures as they stand, but the thinking of management. If you're doing a bank valuation or a financial valuation, yeah, we're going to expect a figure at the end, a number. And that number is going to be very important. And how you got to that particular number, hopefully in dollars, let's do it in that, will be important for us to understand the methodology. So we'd expect a breakdown of earnings. We would expect, if you like, a discount factor. We would expect you to look at every normal available method of trying to figure out how much a bank is worth. But then I want you to look at its strategic advantages. What it is about the bank that made you think of doing it. And it could be access to a major market. It could be because it had been turning over money relatively successfully for a number of years. And obviously, finally, I want to wish you the very best of luck with your dissertations. I will be available on Skype, on telephone, on email for you for any kind of tutorials that you want, or any other kind of way in which we can help you. The same is true for those doing international trade finance, both the foundation course and the advanced structured trade and commodity finance, and likewise those doing the not the core modules but the other modules. In all those cases, law of guarantees, forfeiting, and all of them, we will be there to help you and to hopefully guide you into going well towards getting a merit or a distinction in this. So thank you very much indeed, and I look forward to speaking to you shortly.